expect from the local market. And for that, we're being joined by Chris Weston from IG, and he's in Melbourne. It's a little bit closer to home. Chris, welcome. Thanks for standing by while we covered off some of the stuff that's happening in Davos. Big night for the markets, emerging market issues really at the heart of it. And this is all sort of reverberations following on from that China PMI read. Do you think, though, that it sort of heightened the focus being put on, some of those other pieces of economic data coming from the US, and really just fear moved into this market?
Yeah, I think so. I mean, certainly if you look at the economic data out of the US, I certainly don't think it warranted a 1% sell-off on the S&P for any part at the moment. And I think if you look at the sectors that are in focus, the materials were down just over 2%, and clearly that is purely down to what we saw in the emerging market space. If you look in the currency markets, for example, traders just wanted to be leveraged to safe havens, or should I say countries which have external capital and therefore can reallocate that back home. And you're talking Switzerland, you're talking Japan to a degree, and those were the currencies that really stood out last night. And there was big divergence going through the G10 currencies. There was big buying coming through in the developed market bond space. I mean, US Treasuries were down about 9 or 10 basis points. If you look at the flattening of the curve as well, you can see why the financials were down so heavily as well. So it was a bit of a risk-off market, and I think it was purely down to what we saw in emerging markets. I think China was at the heart of that. It's not just a slowdown in the re-engineering of their economy. There's other issues that are going through in China at the moment, which is causing a bit of a risk-off move, especially in the wealth management space, and what potentially could happen when we see, if we do see a default of this investment trust on January 31st. So I think that was the issue. I mean, and clearly that's why people were looking to sell the Australian dollar. Interest rate expectations really don't come into it at the moment. It's about money managers looking at the emerging market side of things and using the Aussie as their portfolio hedge, and that's why it was really quite aggressively sold off across the curve last night.
We also saw some pretty big moves when it comes to the British pound and the euro, but really we're seeing a really clear divergence in G10 currencies right now. So what's happening? Does it all come back to central bank expectations?
A large amount. I think that for a large period of times there was a rising ship lifted all currencies against the dollar, and no, I think what we're seeing now is the pound and the euro are doing their own thing, and then you've got the block currencies, i.e. the Canadian dollar and the Aussie dollar and the Kiwi to a degree, doing their own thing as well, and they're being. I mean, the Canadian dollar is just getting absolutely smashed this year from pillar to post, and Polar's the head of the Canadian Bank, is quite happy to see a weakening currency. He said that the other day, even though it was down around 7% on a trade-weighted basis. So I think you've got an easing bias there, and I think if you look in Australia, we did trade below the year's lows, or the recent low or the weekly lows today, but we've stabilised and come back a bit above that. And we've still got an easing bias in Australia, and money managers still want to be short the Aussie dollar as a hedge against those emerging market risks there, and that's why you're seeing that big divergence taking part. I mean, sterling's absolutely on a tear at the moment. If you look at sterling against the Australian dollar, it was up at 190. It got up to 190.32 last night, and that's the trade at the moment. Forget if you're a specky trader. Just keep away from the Aussie dollar against the greenback. Trade be long sterling Aussie. I mean, that's just the most absolutely beautiful trend. And then you're seeing other diversification or divergence taking part in the emerging market side of things as well. But that's what we're seeing. It's not just about the dollar rallying against everything. There is clear divergence taking part in G10 at the moment, and largely is down to central bank expectations for sure. Yeah,
it's interesting the Canadian bank moves, because a lot of the rhetoric coming from their central bank is very similar to the rhetoric that's coming from
Exactly.
the RBA as well. Let's leave that for a second, Chris. I want to get your thoughts on US Treasuries. Yields falling quite significantly, in fact. So what do you think this may be telling us about how expectations are lining up ahead of Ben Bernanke's last meeting as the head of US Fed?
Yeah, I mean, that's an interesting point, because US Treasuries now, if you look at the 10-year, which we always look at, are actually trading lower on a yield basis than when they announced on December 18th that they were going to start tapering, which didn't really shock too many people. But they're actually lower now. So whether that's just a realisation of I suppose a risk-off move last night, people wanting that perception of safe haven buying, which obviously people come into the US Treasury market, is why gold did very nicely last night, or whether it's actually deflationary signs that are coming through in markets. I think that's one of the key concerns that people have. I think the two big issues from a macro perspective that people have right now is that there are emerging market risks, But the other thing is what happens to certain developed market central banks if we see continued deflation or disinflationary signs coming through. Maybe that's the issue. But I think, technically you could suggest there's going to be further downside in yields in the US Treasury market. But we get the Fed next week. And I did see 4 out of 45 economists there are suggesting the Fed are not going to taper, which of course would be very, very bad for the dollar. And will be interesting to see what happens to the US Treasury market if that was to occur. But I don't understand what those 4 economists are seeing, considering as even the Doves of late have said that they still expect to see a tapering exercise being announced, despite that weak non-farm payrolls number. So it was a big move down, and there was a flattening of the yield curve. We've got a 241 basis point spread between 2s and 10s at the moment, which are the weakest since November. That to me is a more important issue than what's actually happening on an absolute basis in the 10-year. So I think always look at spreads, I think, in that regard there.
Chris, just quickly, calls for the open for this market?
Yeah, week open, obviously, we're calling it down about 30 points. Interesting to know US futures were down quite heavily, about 0.3, 0.4%. So some of the falls overnight were cushioned. Gold plays naturally in focus. I think Newcrest ADR up about 4%. Should be a good place to be. BHP's ADR down 0.6%, although we did see iron ore hold up. That was one of the few commodities that seems to be up nicely as well. So, look, yeah, I mean, obviously, it's going to be a pretty risk-off day today, but some of the falls were cushioned by the fact that we were down quite heavily yesterday as well. Look at for China when that comes online around 12:30. That could be where our market goes. And the other thing is obviously we've got a long weekend, so you may see people running more of a flat book, I suppose, into the afternoon on the basis there.
Okay, on that note, have a great long weekend, Chris. We'll chat with you next week.
Thanks, Nadine.